Well, thank you, and happy spring, everybody. Nice to see the sun shining and a little bit of warmth. So I'd like today to be fairly interactive. I really want this to be beneficial for you. You took time out of your day to come hear me speak. So I've got some prepared comments, and I can go in lots of different directions. I'll give you a quick background. I'm going to talk a little bit about what our firm does and why we think it's important. I'm going to talk a little bit about the investment world today, and then again I'm going to open up to some questions. My background, I'm a CPA background. I started my career at Coopers & Lybrand, which is now PricewaterhouseCoopers. So I was in that CPA world for a little bit, so I can take some questions on that if you want. Although it was quite a few years ago. I then transferred into a financial analyst position within a firm in downtown. Quickly moved over to the assistant controller side at a company called Loomis Sales & Company, which is an investment management firm. Manages today over $100 billion in assets. Realized that I didn't want to stay in that world. I really wanted to get onto the investment side. I began taking classes at Boston University in their financial planning program. And concurrent with that, began working in the investment side of Loomis Sales, learning the mutual fund business. We had a fledgling mutual fund business, which the firm was interested in growing. So I became very involved in that process, and that firm, those funds have now grown tremendously, and I won't go through all the work that went into that. My real passion, though, was to work with individuals and also institutions and endowments on the investment side, as well as the general planning. So our firm, PRW Wealth Management, was founded 25 years ago by my partners. And what we do is, our tagline is, we provide clarity for your present and vision for the future. And so all of you sitting around here have some sense of how you got to here today, and have some sense of maybe where you want to go, and hopefully through today maybe you'll get some ideas on career paths and direction to go forward. Among the things that we do if we're working with an individual, there are really 5 main things that we're helping people with. One is retirement planning, and when you're in your teens and early 20s, hard to think about that, but certainly quite important, as the pillars that have been there for us from a retirement standpoint are probably going to be different than they are for our parents and grandparents. Social Security, as an example, has always been something that we've relied on, and may or may not be there, at least in the same shape, when you're ready to retire. We help people with investment planning, a pretty difficult task in these choppy markets that we've had and will continue to have as we move forward. Tax planning, the tax code has been changed many times over the years, and with this deficit situation that we're in right now, you can expect that taxes are probably going up and not down, and loopholes are being closed all the time. There are proposals today to tighten up the tax code and remove a lot of the issues that are there today. And if you're in the accounting world or you're focused in that area, I'm sure you're going to see quite a bit of change over the years in the tax area. Risk management, so how do we protect ourselves? Life insurance being a big one, but of course we have risks. You buy a home, well, now you're a homeowner, you need to have homeowner's insurance. You're working, you have the opportunity to eventually get some disability insurance, because if you lose your capacity to earn, you're going to need disability insurance. And then estate planning. So how does this all translate? How do we give our heirs money? And you may have parents or grandparents who've gone through this situation. Do they have a will? Do they have a health care proxy? If something happens to them when they get sick, who's going to step in and help them out? Is there a durable power of attorney to allow somebody else to make decisions in the case that the person that you love is incapacitated and unable to make those decisions? And transferring wealth. Scott and I were just talking about couples in their 70s and 80s. There are 3 places the money can go. It can either go to the government through taxes, it can go to their kids or grandkids or whomever, or it can go to charities. And helping people figure that out is another thing that we spend a lot of time doing. We also, at the end of the day, have hopefully helped kids or people to educate their kids. We help them to retire, perhaps manage while they're in a business, doing things in a financially astute way, helping them to sell a business, figuring out what that looks like after they have given up control of their baby that they started. What do they do now? How do they replace that income? I talked about transferring wealth to the next generation. And on the institutional clients, endowments that we manage, how do we make sure that those endowments are there in perpetuity, can meet the purposes that they're there for, namely scholarships and other spending that colleges are doing. So talk a little bit about investing. And I don't know how many of you are interested in the investing markets. Again, it's where we spend a lot of time here, certainly with ENC. And a few concepts that I'll share with you. One is probably the best one you can take away is it's time in the market, not timing the market. Over the years, we've seen many different people try to time the markets, and that's been a fairly futile strategy. The other thing I've learned in my years of investing is that beating the market as an active manager is very, very, very difficult. Doing consistently is pretty much impossible. There's a firm in our industry called Morningstar. I'm not sure if you're familiar with it or used it. And they track mutual funds, actively traded mutual funds. How have they done? And they have done studies looking at how active managers who've been in the top quartile of their peers have done over rolling 5-year periods. Those that are in the top 25%, the top quartile, in period 5, the first 5 years, the chance that they're going to be in the top 25 or the bottom 25 is about 50-50. So no one can stay on top forever. It's quite challenging. Diversification is your friend. This chart we bring out with clients, I don't expect you to read it unless you have super eyesight, but you can see the different colors. And the colors all illustrate how different asset classes have done, be they large company stocks, small company stocks, international stocks, bonds, emerging market stocks. And the takeaway here is that the colors are up at the top sometimes, at the bottom sometimes. They really bounce around, and trying to figure out and stay the course in any one particular place is not going to work all the time. So having a little bit in each is going to make the better difference and a smoother ride. There's a black line which you can't see, which kind of trends through the middle, and that's the return of having a diversified portfolio. So that's, we spend time educating clients on that. When I joined my partners, it was the end of 2000. I had come out of a firm, as I mentioned, Loomis Sales, and Loomis Sales' biggest fund was a bond fund. Nobody wanted to hear about bond funds in the late 90s. Do you know why? Well, something called the dot-com boom. And all these companies that had no earnings were all coming out to the market in IPOs, and prices were going through the roof, and there were absolutely, again, zero earnings. So everybody wanted to buy that. Why not? Throw a dart, and the company would go up by 100, 200, 300%, and everybody was a genius until they weren't, and the lights went out, and that whole strategy failed. And nobody wanted to talk about bond funds at that point in time. It was during those 3 years when things started going wrong in the equity markets that everybody wanted to talk about bond funds. So the longer you stay in this market, you see that each asset class has its own place within a portfolio. Other things I've learned is to really tune out the noise. I have clients who call up and say, well, I heard on CNBC that we're going to crash next week. Oh, okay, well that's great. Why? Well, did you hear Russia has invaded Ukraine? Yeah, I did hear that. Didn't you hear Syria's got a civil war? Yep, I'm aware of that. And didn't you hear that we're in this major deficit? Yep, know about that. And every year it's something different. The market loves to climb the wall of worry. There's always something. And if there weren't, then the stock market wouldn't provide the returns that it's provided over time. In order to get something, you have to take some risk, and that's what the market is. It's a risky place to be, and if you stay in long enough, you should be rewarded for that. It wasn't that long ago that, I'd say about 3 or 4 years ago, coming out of the financial crisis in 2008, 2009, that the headline news talked about pension plans, and pension plans were all underwater. And think about pension plans today don't really exist in great numbers. They continue to be taken away because corporations don't want to have that risk of providing for their employees. And over the last 5 years, you've seen plans go away. You've seen negotiations with labor trying to reduce the benefits that these pension plans need to pay. an article in the Wall Street Journal, again, this was 4 years ago, that this was the hot topic, pension plans were going down. This is the beginning of the year, a roaring stock market and rising interest rates are fueling the strongest recovery in the $2.4 trillion U.S. corporate pension sector in more than a quarter century, giving companies new flexibility in dealing with some employee benefit costs. Investments in the average company's pension plan are expected to be at levels that cover 96% of future obligations. And that figure drops to about 76% for public plans, which was up from 66% the year prior. So we were in crisis stage in 3 years. The market's suddenly taken these plans up to be almost fully funded. Remarkable what can happen in just a few years. So if you believed that the pension market was going to collapse and that deficits were going to just crush us, and you stayed in cash, you missed one of the best bull markets that we've had in my lifetime, certainly. So it's important to tune out the noise when investing. And also tune out the prognosticators, because everybody's got a prediction, and I've heard some doozies, and in our quarterly letters that we put out to clients, we've talked about the real ridiculousness of these predictions. They're just never right. We've had people tell us the market's going to crash 20% and it was up 30% last year. I mean, and these aren't just guys off the street. This is major brokerage firms that are paid to provide these kinds of analysis. And they're very thoughtful, but listening to them and acting exactly on what they do will not always be in your best interest. So as investors, what are we looking at today? What are some of the things that we're talking to clients about? One is the U.S. energy market. The fracking, we've all heard about fracking and the ability that now companies have to go down, drill for gas, spread it out well below the Earth's surface, and that energy renaissance is helping our manufacturing sector. It's probably going to make us next net exporters of energy. And the reason that's important is, again, it wasn't that long ago that all I heard about was jobs going over to China and to Korea and Thailand and all these other countries. And that's true. We still have some jobs that are going over there. But there are a lot of jobs and a lot of companies that are coming back to the U.S. Plants being built here, automotive plants, all types of manufacturing that was going away. And manufacturing was supposed to be history. I don't know if the curriculum here was going to get rid of manufacturing, but I'm sure it was thought about, because that was what everybody thought. And now you're seeing skilled labor is necessary to run these plants, and that's a great thing for the U.S. markets. Housing. So housing, we saw in 2008, 2009, thanks to very loose lending by banks and other financial institutions, led to a real depression in housing. Well, we've seen that turn around, but we haven't seen it go gangbusters at this point. We've seen a nice upward sloping housing market, but there's still a lot of way to go. We've not seen the supply pick up to meet the demand at this point, so there's still room to run, in our opinion, in the housing market. And over the last 5 years, companies have gotten very strong. Their balance sheets have improved quite a bit. We've had very low rates, as you may be aware, and that allows companies to refinance their balance sheets. And not only companies, but individuals have refinanced to put their own personal balance sheets in better order. So companies are strong. Sitting on a lot of cash also gives us some hope that some good times ahead. Another area we've liked is biotech. Biotechnology has been on a tear over the last 2 or 3 years, particularly as new drugs have been introduced and continue to be found all the time. We're all familiar with Obamacare and the goal to get everybody covered for health care. So health care has been a big theme, and how this all shakes out is anybody's guess, but certainly a lot of companies are trying to keep the cost of health care down by finding these new innovations in biotechnology. And right now we still have a Federal Reserve that's very accommodative. Janet Yellen, who took over from Ben Bernanke, spoke yesterday, rattled the markets a little bit by saying at some point rates are going to go up, and she intimated that it could be as early as 2015 that we start to see rates actually start to rise, which would be a real change in course from what we've had certainly over the last 6 years. So those are some investment thoughts. One of the books that I was sharing over at the table here, it's called Making Sense on the Dollar, and I'm often asked, so what do I give to my child who's just graduating school and facing all the different types of issues that they're going to be facing, from new job, perhaps getting married, buying a home, mortgage, all those kinds of things. This book, again, called Making Sense on the Dollar, is one that I recommend to our clients. It's written in very easy to understand language, discusses how to save for your own retirement, what are all the tax planning documents, what do you need to think about from a tax perspective, how do you want to protect yourself, life insurance, do you buy permanent insurance, term insurance, all the different kinds of things that you'll eventually get exposed to. So if you want to see me afterwards, or you want to write down the name of this book, I'd recommend that you take a look at it. I guess some other general lessons that I've learned during my time. One is to cut out the clutter. Your inbox is always going to be full, and mine is just so overwhelmed. So try to cut out that clutter and keep to what's essential. I think has been important for me to try to stay focused on achieving my goals. I think it's being clear in the goals and how you direct others, providing clarity to others. I always think about the pit stop crew. You ever watch one of these Formula One car racing? I mean, the pit crew, they have this thing down to a science, right? The guy at the front changing the tires and say, oh, maybe you should go over here and they got a flat tire over there, so maybe do this, do that, and they're all working. No, they know exactly what they're doing, piece by piece. So being clear in what your goals are, and especially within a team, I think is quite important. And running a small business like my partners and I do, that's been very crucial, is to make sure that people are clear on their responsibilities and their roles in the organization. Peter Drucker, who's a pretty famous management consultant. If you've not heard of him, I recommend maybe Googling him and taking a look at some of the books that he's written. Perhaps you've read some. One of the things he said is effective people are effective because they say no. I can tell you, as you move on in life and you have kids and you have taking care of parents, and you're tugged by every organization that wants your help and time, that being able to say no is one of the more critical skills. And in business, you get many, many different opportunities. Being able to say no. If you look at private equity firms, the more successful ones are the ones that look at 2,000 deals during the year and say yes to 5 of them. It's because they have the fortitude to say no to those deals. And I guess one that I tell my kids is to never get complacent and to learn to survive your success. Always play like you're in second place, because there's always somebody who's going to be better with you. Never get too high on what you've done. So those are my prepared comments. What is it that I can talk about that would be helpful? Are there any questions that I can answer for anybody? What worries you guys? So your various levels, freshman through senior. Some of you maybe graduating, moving on to the next step. I read a lot about the millennials, right? It's millennial generation and how it's different. And I'm wondering, well, how is it different? What are the things that have changed based on where you've been growing up? Again, I talk about 2008, 2009, which is a watershed event, hopefully a once in a 100-year flood that we had. But it's impacted. It's been right in the heart of your lifetimes. And I'm curious, what that means for anybody. What are the things that you're thinking about? Are you just thinking about the next test, or thinking about what I'm going to do this summer? Yeah.
I guess coming from my perspective, growing up through the crisis, is we kind of expect that there's going to be a drought. So like going into graduating college, like I'm expecting okay, jobs might be a little slim, like it might be hard to find a job. You hear about all these people who go to college and then like 30 degrees of uses and they're at home trying to find a job. So like I guess from my perspective, coming out of living through the depression, like as like a majority of my life where I'm educated, I expected like to not get paid much when you get out of college, to have a mediocre job. Like there's kind of that expectation for myself that things are rough, and it's like I'm used to it being rough. So like I guess that's how I feel coming out of it.
Anybody else? Does that ring true in your feeling? Anybody think that they have it all figured out. They know where they're going to go, what's going to be the next step. Are there any, is anybody interested in the planning profession? Do they think that this is something they want to get involved with? Anybody interested in just investments, want to go out and be an investment manager, stock picker? Is there anybody coming out who's interested in corporate finance? Is there anything I can answer there? So corporate finance. Lots of different avenues to get involved in these things. I have seen, and we entertain, interns who come in and want to learn the business. When I am seeing a pickup in things, and you've got big companies out here. Certainly they've downsized, but I do see a pickup in things that could present some opportunities for people who are, coming out of school. You've got some major corporations. Boston's a terrific area for the financial services. And I see things changing. I do see, different levels of skill sets. I think one of the most important things coming out is really being able to communicate. If you're an accounting major, having the ability to communicate is going to be quite valuable to you. And I was with the big four now, big five public accounting firms. They're looking for people who can get out there and communicate. Any other questions that coming up? Yeah.
You've had a lot of schooling from all the different colleges you mentioned.
Mm-hmm.
I wanted to know how you stay motivated to just keep going.
So how I stayed motivated to keep going through each. Yeah, so I had a liberal arts background, which meant I could come out and go in lots of different directions or no different directions. So when I came out, there was graduate school as there is today, and try to refine what I wanted to do. And what I would say is what you start out doing is probably not what you're going to be doing 20 years from now. Maybe it is. Some people do find that. I think persistency and perseverance and dabbling in different areas. When I was in public accounting, I didn't want to stay on the audit side, so I started to learn about the tax side. They had a consulting group. I started to learn about the consulting group. So I found starting with some of these larger companies where I got in and was able to work my way around and figure it out during that time was helpful. I just spent time trying to figure out what I was good at. I read What Color's Your Parachute. I read some of these other kinds of books that help identify what you're good at. And there's Colby testing you may be familiar with that. Helps you to figure out, again, where your strengths and weaknesses are. So motivation for me was I wanted to succeed. I wanted to do well. I knew I wasn't going to be an artist. My sister's got those genes. So certain things were eliminated pretty easily. The business side was something that I had an interest in. Becoming part of management was something I also wanted to do, and knew that I couldn't get there without paying my dues and understanding what it is that my people are doing. I find that there are a lot of managers who've maybe gotten to a point where they've forgotten what it is that their people are doing, and that is sad because they can't relate to them, and you have unhappy people in both directions. So I don't know if that did a good job answering your question, but I'd say just try to find what your passion is and go with it. And I recognize that you're not going to start out at the top. I think that's just something we all have to face, that we have to work our way through it and never expect that. One of the other things I've taken away is that good things will come to those who wait. Now, it doesn't always happen that way. People they do the right thing and it doesn't always work out for them. But I do find that putting your head down and doing a good job, that is more often than not rewarded. So, yeah, Bill.
You said you represent institutions as well as individuals.
Mm-hmm.
I want to point out to the class that this is one of the institutions that you represent. And we have invested quite a bit of money in the judgment. I want you to talk about kind of this kind of natural conflict. It's not always a smooth road. Our association, our finance association, might come in and invest millions with you, and they have ideas how they like to see it invested. I'm sure you work in a business every day, you have ideas. And does that create a risk of clash, or how does that work? And how do you find the balance?
Yeah, so I think maybe what Bill's talking about is when we have constituents. When I work with an individual, I have that individual's opinion. I might have his wife's opinion. Maybe his cousin told him something, and they ask us about that. Should I buy XYZ investment? When I work with a board, everyone's got chirping in my ear. Should I do this, that, or the other thing? And it does. Sometimes there are great ideas that come out of that, and you have to be open to looking at those ideas. But at the end of the day, you have to make a decision on what we think is the most beneficial way to manage the portfolio. I'll give you an example, not for this, for ENC, but for another endowment that we manage. I had a person who was pounding the table for gold. Gold is one of those investments that gets a lot of press, and in times of strife, people feel that that's the best place to be. And since 2000, it had a terrific run, and over the last 3 years, it hasn't been a very good place to be. But a person was pounding the table 3 years ago. We needed to be in gold right at the peak, and I share with him the reasons that I just wasn't comfortable with it, and that we just weren't going to do it. And he was one voice on the board, and we were it proved out that was the correct decision. But it doesn't always come out that way. So there are conflicts, and we explain our rationale. We explain what it is that we're trying to accomplish. And there's always going to be somebody who's got an advisor or a friend or family who thinks that they know the best way to do things. In this business, there's a science to it and there's an art to it. No one's got it figured out. If they did, then they probably wouldn't be working, right? They'd have their own money, they'd manage, and they wouldn't need to work. So you do the best that you can with what you have, and you try not to get too drawn into any one particular way of thinking. Try to keep that open mind and solicit opinions. I think really in anything that you want to do, you need to do that. And as I said earlier, being able to say no is quite critical, because you get a lot of great ideas, and when you flesh them out and think about how they're actually going to be impactful to your life or to a portfolio, at the end of the day, they may not really add enough value or potential risk that it's really worth the effort. So, any other things I could answer? Yeah, anybody going into the interested in? Are there any particular companies that you're potentially interested in that I could talk about, or anything you're hearing on the news that has got you interested?
You can talk a little while they're thinking. Maybe
Yeah.
talk a little bit about risk rating. Maybe we can expand on that. This morning I was watching the news, and they did a little. I wish I could remember the exact numbers. Maybe you'll have something close in your head. But like I said, if you put 100 in the market in 2008, it would now be worth $258, $260, something like that. If you put that same 100 in the bank right now, it'd be worth like $100 and change.
Right, right. So I mentioned earlier that there's this trade-off between risk and return. And the more risk you take, hopefully the more return opportunity, but with that reward comes downside as well. Understanding how you feel about that is quite important. And staying the course. So there were a lot of people who felt the kitchen got a little bit too hot in 2008 and 2009 and chose to sit out what has been one of the largest bull runs that we've experienced in our lifetime. And Scott's referencing that had you been one of those people who sat out, and I can tell you that there are institutions, not just individuals, who sat it out, regrettably so, because those decisions are super impactful. You can't go back and get those dollars back. In fact, there was an article in the Wall Street Journal on Saturday that talked about just this concept. People who had gotten out of the market in 2008 and 2009 and now are saying, boy, I've just seen this 5 years worth of tremendous growth. Now things look good. I want to get in. I want to get some of that. Well, you don't get a second chance at those huge runs typically. So it's a problem. So how do you avoid being in cash, but how do you avoid being all in equities and having that that potential for a big loss? And it's by this chart I showed you. It's by maintaining some diversification. One of the things that I hear today is that bonds are a very risky investment. So if you think about what the financial markets opportunity set is, you can be in cash, you can be in fixed income bonds, you can be in some sort of stock, you can be in private equity, you can be in real estate, you can be in venture capital, and a whole slew. You can be a business owner, which certainly has its own risks, and a whole slew of other things. But those are the main categories. And we can, through analysis, look at since 1926, when the records go back to, look at what returns have been for different asset classes over time. And if you look at that chart, you will see that small companies have returned somewhere around 12% over that time period. Large company stocks about 10%, bonds about 5 or 6%, and cash about 3 or 4%. So anybody who wants to make the most money, well, let's put it into small company stocks. Why small company stocks? Because they have the most opportunity set. If you're a large company, it's hard to grow. Typically, if you're a small company, you have a much better opportunity to potentially grow. And maybe if you do a good job, if you find the next great product, and a big company decides, well, rather than build this ourselves, we want to just buy it already made, they might buy your company. And we've seen some of the companies that have been bought today by the big guys like Google, these for billions and billions of dollars, Snapchat and other ones that I'm sure you're all familiar with, have made instant billionaires out of a lot of people. But these are small, nothing companies in a quick time frame have turned around. So those are some of the small, riskier companies, because they, while this guy's building it and that woman's building it and everyone's out there building their own thing, not all of them are going to survive. So first to market often will trump, and certainly a better product hopefully will trump as well. So if you look at all those asset classes, if you want to have a portfolio that's going to get you through, you need to have some of the small, some of the large, some of the mid-sized companies. You want to have some international exposure. Today, which is a little different than the last maybe 20, 30 years ago, a lot of domestic companies are getting their business from overseas. If you look at a company like Coca-Cola, they get over half of their revenues from overseas. So some people argue I don't need to have international companies in my portfolio because I've got exposure to these international places through companies like Coca-Cola and IBM, Google for that matter, getting huge revenues from overseas. What we found is that that's nice that they're doing that, but it doesn't really matter where you're domiciled. So Nestle's is domiciled in Europe, and they get a tremendous amount of revenues here from the U.S., but they have exposure to a lot of the emerging markets where you have a lot of newfound wealth companies. These countries are typically natural resource rich and have been doing well over the past few years. Over the last really 20 years, they've migrated up, they have more money to spend, and they're spending it on chocolate from Nestle's and coffee from Starbucks and all these places. So Nestle's is not here in the U.S., it's outside the U.S., lots of opportunities set there. Was there a question? No? Okay. I don't know if that did a good enough job, Scott, of answering the risk-reward question. But so putting these together, this sheet which I shared, for the last 20 years, mid-cap stocks were up 11% over that time period. Over the last 20 years, small caps 9%. A diversified portfolio was up about 8% over that time period. So we didn't get the 11, 12, but we didn't get the flat. You got 8%, which is a pretty respectable return over that time period. And that's going through the years 2000 to 2002, when we had this .com crash, if you will, as well as 2008, 2009, when we had the financial super recession, or whatever it's going to ultimately be called. Other asset class I didn't talk about was commodities, and that shows up on here. And commodities, I did mention emerging market countries tend to be rich in those commodities, and that's an asset class in and of itself that historically has been one that people have focused on, especially when they feel that there's inflation on the horizon. Inflation has historically been about a little over 3%. Over the last, I want to say 7 or 8 years, we've been about 1.5%, so much less than what we've seen. A little inflation is a good thing. It's the only way that companies can grow is if they're able to charge a little bit more for their products. But I can tell you that sneakers, those sneakers you're wearing, they're probably the same price as they were 25 years ago. Sneaker prices have not really increased that much because the low cost of labor. They go over to other countries and get things done fairly cheaply. Has kept a lot of costs down quite a bit. The other thing I mentioned in terms of commodities, energy and oil, again, for many years growing up, we were all dependent on the oil from the Middle East. And with this newfound energy here in the United States, our dependence is going to be decreasing quite a bit from what we have historically seen. And that's only going to benefit us, I think, in the long run. So, as you can see, there's lots of different directions that you can go in this field. I'm passionate about helping people, be it students who are trying to figure out what it is that they want to do, be it young families who are trying to figure out how am I going to educate my kid, put food on the table, save for my retirement. There are all kinds of different trade-offs. How do I buy my first home? How do I protect myself? All those kinds of things. And I like working with families who have or business owners who are just trying to grow that business, and they're so focused on how do I get that business up and running, how do I make it successful, that they fail to protect themselves, or they fail to put aside extra funds for a rainy day. And we've had some pretty torrential downpours in the last 10 years for sure. So those kinds of things have been very important. And then I was talking with Scott earlier about giving, and there are a lot of generous people out there who have done tremendous things, and there are huge foundations. But then there are some people who give away money, and you'd never know that they give out money. I had a woman who she'd give a $25 tip to the paper boy, and he thought that's just fantastic. She was worth $25 million, and just you just don't know who's out there. There's all kinds of crazy wealth out there, and but back to the charitable giving, I guess. Lots of different ways to do charitable giving that can benefit both the donor and the donee, and the tax code has provided some opportunity. Life insurance can play a big role in charitable giving and wealth transfer planning, so we spend a lot of time with that. There's something called the estate tax that my partners and we have an in-house estate planning attorney spend time viewing. I'm not sure if you're familiar with the estate tax, but they call it the death tax. So when you die, and all of us are going to have that happen at some point, the government looks at your assets, and if you have over today per individual about $5.2 million, the amount over that is going to be taxed to you, or your heirs are going to have to pick that up out of your estate. The state of Massachusetts has a threshold, and that's just over $1 million. So any money you have over $1 million gets taxed at a rate. A lot of people don't know that. It's all a problem we'd love to have, probably, right? We'd like to have the $5 million, and we're going to be dead. We're not going to have to deal with it. But a lot of my clients don't want to have to give money to the government, so they come to us and they say, well, how can we avoid giving money to the government? And there are a lot of legal ways that you can do that, and we do spend time in that area as well. And again, as I said at the outset, tax rates aren't going down. I did talk about the pension crisis. It's not solved, but it's certainly a lot healthier than it was before. The deficit is not solved. It's not going to be solved anytime soon. It is improving. You haven't heard a lot of deficit talk. You heard the debt ceiling went up. They basically, the government, the Congress said we're going to take a moratorium on this decision about whether or not to raise the debt ceiling. Is everybody familiar with the debt ceiling? Okay. So now that at least this year we don't have to worry about it. It was last, I think, October when it came down to the last minute to decide whether or not they're going to raise the debt ceiling. With that off the table a little bit, Congress can continue to hopefully do some things to to help shrink the deficit. I can tell you that we're seeing revenues increasing. We're seeing deficit decreasing a little bit over the last, I think the last 10 months. We've seen a meaningful reduction in the deficit. It's certainly going in the right direction. The most recent tax hikes that we had, including a 3.9% Medicare tax on families that earn over a certain threshold of income, combine that with higher capital gains rates and people just earning more, all those things are helping the tax coffers are helping to reduce the deficit. So again, one of the other positives that maybe balances out some of the negatives that if you're a reader of the paper you're hearing about. So, and I didn't even mention the Malaysian aircraft because that's something else to worry about, but all kinds of things. So, anything else? Good. So hopefully that was helpful. I know we went in lots of different directions. I wasn't quite sure what kinds of things would be on your mind, but I'm happy to leave my information with Elizabeth, and you can call me, email me, whatever you like. I'm happy to answer a question offline. And on any kind of topic, as I said, this was meant to be fairly free form. I think it was just that. I hope that you are all very, very successful. I know you've chosen a great school to get your education, and I know you've got a very dedicated staff here, and from the president on down. So you should feel good about that. You've taken a great step in preparing yourselves for, well, I think it's going to be a great future. I think there's lots of great things. It's going to be difficult. You live through difficult, so I think in some sense that's probably a good thing. People born into the really good times have known nothing but good times. You've not just seen that. You've seen that it can be difficult. So I hope you're challenged by it. I hope you go out and do some great things for the world, and thank you very much for your time.